So once we've made all the journal entries and posted everything to the ledger, these are the balances in the accounts at the end of the accounting period. However, as you've learned in this chapter, there are certain adjustments that we typically need to make at the end of the accounting period because it just doesn't make sense to make them every single day as we go through our day-to-day operations. For example, depreciation. Right? We wait till the end of the accounting period and typically record it then, maybe at the end of every month, but definitely it would not be customary to record that on a daily basis. So we have these balances here. There are a couple things that we're going to learn about. It says, for preparing the adjusting entries, the followed data was assembled. So we're going to learn here, there's a couple things here. We have fees earned but unbilled on April 30th of $10,000. Okay, so these amounts here, we've earned these guys. We've accrued them, however, we have not recorded them yet. So we haven't billed them, and they show up nowhere in our accounting records at this point. So we need to make sure that we make a journal entry to put those guys into our accounting records. And this is what the journal entry would look like to include those accounts receivable and the fees earned. Okay, so now we're not going to debit cash because we didn't actually receive the cash. We received the fees, right? I'm sorry, we earned the fees. And instead of receiving cash, we have essentially a promise from them to pay us, like an IOU, right? Okay, so once again, let's take a look down here. It says supplies on hand on April 30th were $8,150. Okay, we showed $21,600 as our balance. We're getting to the end of the accounting period here, and we're learning that, hey, look, after we took an inventory of things, all we have is $8,150. Well, we look at the difference between those two. If we started out, or if we had a total during the accounting period to use of $21,600, and we only have $8,150 left, if we look at the difference between those two, we'll see that it's $13,450. So let's take a look at the journal entry that we would make. So this is where we've calculated the difference between what we had access to and and what we had remaining at the end of the accounting period. So that means that we used $13,450 of our expense. So here we're reducing an asset with a credit and increasing an expense, which reduces our equity. Okay? Let's take a look at the next little bit of information. It says depreciation of equipment was estimated to be $13,800 for the year. Okay? So we look up here, we see that we have equipment. Well, I don't see accumulated depreciation anywhere. We don't have that account made for us yet. So that would be something, if this was the first time we were recording depreciation, we would need to actually add an accumulated depreciation account. So let's take a look at what the journal entry would look like for this one. Okay, so right here with C, $13,800. So the way things work, we record the purchase of equipment and we treat it as an asset. But over time, the equipment wears out. Okay, we use it. And what we do here, we want to uphold the matching principle, which states that we need to record expenses in the same period with the revenues that it helped earn. Okay, so if we buy equipment and we think that its useful life is going to be 10 years, that it's going to allow us to be, it's going to be used by us for 10 years to help us generate revenues, well, we need to split that guy and allocate it accordingly. Okay, so it was determined. We didn't actually come up with this here. They just told us that this was the dollar amount. But this here, this represents an expense, and this credit here represents a reduction in our assets. But instead of crediting the equipment account just by itself, the account that we generated when we purchased the asset, we use this what's called a contra account, accumulated depreciation. Okay, and so it has the same effect, right? So instead of just crediting the account and debiting it when we buy something and then crediting it when we actually depreciate it, we keep this depreciation separate. And that way we can see the historic cost. Remember, we have to maintain the historic cost principle, which means that we have to see what we paid for the equipment. So if we reduced the equipment account, we would have no idea, right? So what we use is a separate account called an accumulated depreciation account. It has the same effect on our total assets. It just allows us to see what we paid for it and how much of it was actually depreciated. Okay? It says, D, the balance in unearned fees represented the April 1 receipt in advance for services to be provided. Only $19,000 of services was provided between April 1st and April 30th. So let's take a look up here and find our unearned fees. So we have $24,000 here, right? It says we have $24,000, and it says only $19,000 of the services was provided between April 1st and April 30th. Well, this is really the only key piece of information we need, because it says that only $19,000 of this was provided. So that means that we earned $19,000. So these unearned fees, that would be where we were paid in it. I'm sorry, where is it up here? This $24,000 we were paid in advance, and over the we performed the work, but only $19,000 of it during this accounting period. So that amount, we need to increase our revenues and reduce our liability of unearned fees. Okay, let's take a look at what that entry would look like. Okay, unearned fees. We're debiting a liability account here, so that means we're reducing it. And here we're crediting a revenue account, which means that we're increasing it. So we're reducing the liability and increasing our equity, right, through an increase in revenue. Over here it says unpaid wages accrued on April 30th were $1,770. Okay, so that means that these people have performed work for us. We haven't recorded the expense yet, and we haven't paid them yet. Okay, so what do we need to do? We need to do two things. We need to record the expense, which we've done right here. Excuse me. And we need to record the liability, $1,770. Okay, so we're reducing equity through an increase in expense here with a debit, and over here we are increasing our liability with a credit. Let's take a look at what else it asks us. So we've journalized the entries as of October 30th, 2012. The next thing it says is to determine the revenues, expenses, and net income for Oconto Company before the adjusting entries. We can see here $543,000. That is the total there of our revenues based on the unadjusted trial balance. This is the unadjusted here, right? Our wages expenses $126,000. 96 for rent, utilities $69,000, and miscellaneous expense $10,800, right? All of these four here add up to $301,800. The difference between all of our revenue and all of our expenses at this point is $241,200. Let's take a look at that. Okay, so this was our total revenues. This is total. This $301,800 is the total of our four expense items. Okay, the next thing it asks us is, after we've made the adjustments, what is the balance going to be in our revenues, expenses, and net income? Okay, well up here we had the $543,000, and what happened if we come over here, and we're going to see an increase of $10,000 and an increase of $19,000. Let's take a look here at the journal entries we made. Fees earned, credit $19,000. Fees earned, credit $10,000. So those two there are the reason that we have now a larger balance in our fees. Let's take a look here at the change in expenses. So up here, all those four, those were $301,800. Let's take a look at some of the journal entries that affected it. Okay, supplies expense. We had a debit here of $13,450, so that's an increase. Okay, $13,800 for depreciation expense. There are no expenses here, and down here wages expense $17,700. We add all those together, our expenses went up, and so did our revenues. But what happened? If we look between the two here, our net income actually went down, and went down by $20, right? So when we make these adjustments at the end of the accounting period, they're necessary, and it's important to make sure that we have the expenses and income for the proper period properly accounted for, and that our balance sheet as of a specific date, we have the proper balances. And that is the reason that we need to make these adjusting entries.